Hey guys, this is Ken McElroy, and you are listening to the Mailbox Money Show with Bronson Hill.
Welcome to the Mailbox Money Show. I am so excited today. I've got Sarah Sullivan here, who with SuGo Capital has done a ton of stuff, not just in multifamily, but in alternatives, in businesses, in oil and gas, and other types of alternative investments, and just really making a big difference. I'm really excited. If you don't know Sarah, she's great. We get into a lot of things about how to vet deals, particularly oil and gas and other types of deals. She gives a strategy on how to do this that I found really, really interesting. I took some notes on it, and we have our own diligence process, but it's always important as an investor that you have some process that you put deals through. And in my book, Fire Yourself, I talk about this. How do you vet the market, the operator, and the deal? I call it basically your deal funnel. How do you funnel that deal through a process so that you can get to where, hey, this is something I am going to move forward on, or I'm going to pass on. So let's jump in. You're going to love this interview. Welcome to the Mailbox Money Show. I've got my friend Sarah Sullivan here. How are you, Sarah?
I'm doing great. Happy to be here.
Awesome.
Thanks,
It's good to be
Bronson.
here. Yeah, the last time I think I saw you at a there was the I Survive Real Estate event, which is a charity event, and then right before that we had our event, which is the Real Estate Investing Summit, and we decided not
Yes,
to do it this year, but it was really great hearing you speak and share.
great
And
event.
one thing I just really appreciate about you, I think you're very similar. That you really, I think you do a great job of really breaking down how investments work and really what
Mhm.
people's goals are and getting outside. Real estate is great, and there's some things that are outside of real estate that are also
Yes.
great too. But why don't you give people a little bit of sense of your background? I know you have the extensive corporate background and how you got into SuGo Capital and doing what you're doing.
Yeah, definitely. So I grew up thinking what probably most everyone who's listening thinks or has thought or grew up being taught and thinking that the best way to make money is to go to the best school, get the best grades, get the highest degree, get the best job. And so I was definitely on that route until I had my two kids. And I was like, wow, okay, I am working my butt off for someone else, and I'm not making nearly the amount of money I need to feel financial freedom, much less travel, do things with my family. I had no time freedom, very little financial freedom. And I was spending way more time with my boss than with my kid. And so I was
That's
like,
so
why
good.
have kids if
Yeah.
you don't see them? So I was working in Silicon Valley. I worked at tech companies, director of engineering at numerous tech companies. And during COVID, when we were acquired by a company, and that was when I said, okay, it is time for me to make a shift. It's time for me to go full on into real estate. So before that, I had been investing in real estate. And it might be like many of you listening, where you have some single family homes, some duplexes, maybe even a dozen doors. But you look at how much you make per door and the amount of time you're spending on that door. And I was thinking to myself, man, I'm going to need over 100 single family homes to get to where I need to be
Yeah.
on the financial freedom
Yeah.
leader. And then I'll have zero time. And and so I started investing passively in multifamily. This was probably 2017. And I was like, this is my thing. So I tried over 15 different types of real estate investing. And so if that's you, if you haven't found your niche, just keep going, keep listening, keep trying, because I tried a lot of things where I lost money or didn't make much money. And then I found the thing that worked really well for me. So for me, it was multifamily. Of course, I arrived in the heyday. And so it was great for several years. I built up SuGo Capital, and we acquired 36 apartment complexes with our investment community. And then we pivoted in 2022 because we realized maybe the heyday is taking a pause.
Yeah.
And so we pivoted and said, what else can we invest in? And that's a really good message for all the listeners, is that not one investment is going to be the right investment for you for the rest of your life. And I kind of got stuck in that, where like, oh, this is my niche. This is my happy spot. This is my path to everything I want in life. But then the
Yeah.
world changed, the economy changed, interest rates changed, there was COVID, there was, tax increases, insurance increases. And I was like, okay, this is not my
Yeah.
happy place for 100% of my money. And I realized we were personally over leveraged in one type of investment, multifamily. And so we
Yeah.
started to branch out. And then we did the same for our investors. And so SuGo Capital now is an investment firm that has multiple assets, multiple funds in different categories, so that investors can really build out a solid portfolio that has some of what they like and some other things that might be new and interesting and fit some other financial goals, because we have to be experts in multiple things because the world changes. So we might shift more into one thing and then shift away from that and shift into another thing. So
Yeah.
that's what we've been doing over the last few years.
That's great. No, I love what you shared because yeah, I think sooner or later we have that revelation, and this is the Mailbox Money Show. People are realizing like, hey, I should be doing something beyond my job. And Warren Buffett has that saying, right? The unless you learn how to make money while you sleep, you work until you die. Ironically, Warren Buffett's in his 90s and he's still working, but he's doing it in the way that he wants to do it, right? And you and I were still
He
working,
doesn't
but
need
he
to.
doesn't
Yeah,
need
it's
to, yeah.
optional.
And so, but you don't realize if something happened, God forbid there was a health issue or a crisis or a
Yeah.
family member, or you just, you wanted to take time off, well, most people would not be able to do it. And so, creating these alternative streams is great. Now, you
Yes.
actually had a very similar revelation that we did in 2022 that we're doing a lot of multifamily. And then we basically kind of took a pause on it where we said, well, we need to find stuff that cash flows. We saw
Yes.
there was some pain that we experienced from, rates going up so quickly and just valuations
Yeah.
coming down. And so now we're getting back into multifamily, which is, we're seeing some stuff in great markets like Dallas or Charlotte at 30% or higher discounted. And so
Yes.
everything's funny. Everything costs more. Like, groceries are 50% more than they were in 2020, but apartments are 30% less. Like, it's just kind of wild, like how some of this stuff exists.
Right? Everything's changing. You got to redo
Yeah.
all your modeling.
I know, I know. And then for you, you really, and I think this is what we really do, and I think you do the same. You try to figure out what someone's goals are, and it's either cash flow, so they can cover expenses, or they
Yeah.
can quit a job, or they whatever the thing is. They
Mhm.
have maybe they're higher net worth, and they just need appreciation or higher upside, or they need tax benefits, right? So you
Mhm.
found various investments that have helped that outside of real estate. What are some of the things that you've kind of found the last couple of years outside of
Yeah.
real estate that's helped to do those things?
Yeah, definitely. And that's exactly right. I found that investors have three main goals, three reasons they're investing. One, they're investing as part of their tax strategy. Two, they may be investing for cash flow as part of their strategy, or that's their main goal. And a third main goal is for appreciation, for
Yeah.
wealth building. And so we decided, okay, let's have something that's strong in each of those three categories. So like you, we still do multifamily real estate, currently not at the same volume. So instead of 10 per year, we're acquiring 3 per year, but we all expect that to change in 25, I hope. But
Yeah.
yeah, so we really were looking for something that could mimic real estate in that it could have a tax advantage, it could have cash flow and appreciation. And we looked at a bunch of different things, and we really like oil and gas because it does, most funds that you find can do a 75% write off from your AGI. So you invest 100K, you take 75K off your AGI for that
Amazing.
year. And so it doesn't matter if it's your passive income, your active income, it just comes off the top. And so that's really strong. That's even easier and better than real estate, right? Because real
Yeah.
estate, you have to be a real estate professional, or it has to count against your passive income.
Right.
Oil and gas, it's like, oh, you're doing an IRA, a Roth conversion. You can, take away your tax on that, reduce your tax on that. You're selling a
Yeah.
property, instead of 1031 exchanging, you can invest in oil and reduce your tax on your property sale. So it's
Yeah.
much more flexible, the oil and gas. And then on the tax side, and then also there's so many ways that people structure oil and gas investments. So you could go all in for cash flow. You don't care about appreciation, and you find something that's, existing. It's a fund out there. It's been running for years and it has cash flow.
Yeah.
And so you can still get some benefits. And then, or you can find something that is just kicking off, like similar to multifamily, you could have a plot of land and you're going to build a property and then you're going to sell it. So you can find oil and gas investments like that, where it's some land, they go drill, they get 20 working wells, bundle it up and sell it off to someone who just wants the cash flow and none of the risk. And so you sell it with appreciation. And there's some, they exit in 4 to 5 years, like a syndication, 2x your money. And there's others that say, we're just going to stay in for the next 30 years. So there's a lot of flexibility in oil and gas as far as the returns that investors receive. So we branched out, and each year we have an oil and gas fund that we offer to our investors, and each one's going to be a little bit different. But we really like that for its flexibility. Now, I would say the risk is a bit higher, disclaimer, because it's
Mhm.
like new property development. Like, you don't know, it's not there yet. You have an
Yeah.
idea, but you need to make it happen. And so drilling for oil is kind of like that. But the tax benefits are really nice, and so a lot of investors say, the risk is worth worth the tax benefit and the projected cash flow. So they
Yeah,
like
no,
that one. Yeah.
yeah, it's a really good point. And we do a fair amount of oil and gas too. We've done a couple deals. We did one that was owning land. It was less of a tax play. It was more of owning the land, which was like,
Hmm.
day one, not, within pretty quickly, 15 to 20% cash on cash. And then
Yes,
it's a high multiple
exactly.
because you can participate in future wells, but less of a
Yes.
tax play. But the tax benefits, the other one was a kind of a VC deal or kind of a venture startup deal within the tech space of oil and gas, which is interesting. But we're actually got another one coming up where we're going to be doing it's the ordinary income tax reduction and that kind of thing. And it's really amazing because in California, we both live in California, and some of these, my background's working with physicians. Some of these guys are
Yeah.
paying, 39%, top tax rate for federally. And then I think is it like 14 or 15% for the California. It was 13. I think they raised it to like 14. So it's over
Yeah.
50%, plus the other taxes and things. So much money. So there are very, very few things besides oil and gas that you can actually reduce ordinary income with. And it's almost like a double return, right? Because you're getting the
Yeah.
return from the investment, hopefully, and you're getting the
Yes.
tax. You don't want to do it just for the tax benefits, but you can
Right.
find a great operator. Let me ask you this. I know you have stuff that you offer. We do as well. How do you, in the oil and gas space, how have you identified great partners in that space? Because I think for a lot of people, they'll say like, yeah, that sounds great, but like, I don't know. There are a lot of snakes in the grass over in that industry too. So how do you vet
There
and
definitely are.
identify great partners?
Yeah, that's a great question. So I go out and see people in person at trade shows and stuff like that, the large trade shows. And then I'll kind of create a funnel and I say, okay, I like the structure of what is being offered. It fits my goals, my investors' goals. And then, I'll meet them in person. I'll go out, I'll look at their wells, their fields, their equipment. I'll go visit their team in the headquarters. I usually do about 9 to 10 months of due diligence on the team. So looking at what have they done in the past, their current fund structure, if it's already existing, looking at the financial reports on those, speaking to their CPA, if they have one in-house or external, and really getting into the numbers to verify them. You can also in Texas, which is where we do all of our oil partnerships. You can take the information that they give you and you can go verify it. So and you could go to the website and you could say like, okay, I'm going to put in this
Hmm.
lease number, this well number, that yada. You can put in the
Let's see if they
information and it
have
says,
it.
okay, this
Yeah.
is owned by X, Y, and Z, or it's not
Right.
owned by X, Y, and Z, and then you go, oh my gosh, okay. And then we also hire a private investigator on all key members, and we use
Mhm.
Toltec, and we give the address, the birth dates, and the name of everyone who has a voting right in the company, and anyone who will be client facing, basically, because you can have great people in the head, but their investor relations person is telling lies.
Yeah.
So we do a background check, and it's not just we put it into a website and it gives us a printout. It's actually a private investigator that we hire, and they go and they do a 20-year background check, and they verify, if I say, hey, this operator gave me all this information, and they go verify it and say, yep,
Yeah.
this is their company. Nope, that's not their company. Nope, that was false. Yep, this is correct. Oh, they were arrested 3 times. Oh, they didn't tell you that? Okay, walk away from that one.
Yeah.
Yeah,
Yeah.
because people always put their best foot forward, and I think that it, what someone did 10 years ago could still be very relevant to how they might do business today.
Yeah, no, that's really great. I love that. I love the, I haven't heard that before. The private investigator background. The
Mhm.
company called Toltec, you said that's who you use?
Yes,
Okay,
yes,
awesome.
yes.
That's
And
great.
then
I
now
think,
our investor community, I've said that a few times in our webinars, and now our investor community uses Toltec, and Toltec's like, wow, look at all this business.
yeah, yeah. They're like, thanks so much, Sarah. This is awesome. We're just
Yeah.
background checking every Toltec. How do you
Mhm.
spell Toltec?
Toltec.
OT Toltec. Okay, cool. I'm
Hmm.
curious. That's great. Yeah. Yeah, we do background checks on partners, but I think that's a whole nother level when you have a private investigator involved. And I think it's really great for oil and gas because I think real estate is a little easier to
Yeah.
verify just who's the
Hmm.
person involved, what did they buy, and so it's a little easier to
Hmm.
kind of from a surface. But for oil and gas, there's a lot more technical things that are going on, like you said, plots and things that are there, and making
Yeah.
sure that the lease numbers are good and what actually is the track record. And there's some
Hmm.
ways people were talking about before we started recording. Some people will say, oh, this was great, but then this person quit their thing and they started this other company. And so it's like, it's just really helpful to
Yes.
have all that information. And it's not that, I was at Limitless speaking with Ken McElroy recently, this couple weeks ago.
Mhm.
And, we have not had any losses of investor capital. We have some deals that are at risk, particularly in multifamily. We got a couple that are at risk. But Ken has lost money and he publicly says, "Hey, we've done this, and this is what we learned, whatever." So it's not
Yep.
that someone has done something and they can't learn, they can't grow from it. I know people that have had challenges, but it's just so helpful to know what you're getting into on the front end. And there's so many things from deals that you just kind
Yes.
of wonder. You don't know until you're like 6 months or a year in. And there's the only way to figure that out is either talk to an investor who's invested for 10 years. It's not like somebody they gave you, but it's just like
Right.
an investor. And so I love that. I really love that. That's really a great strategy. What are you seeing right now? I want to actually ask you specifically about multifamily. I know you've done a lot in the space. You
Yeah.
guys pivoted a little bit. Are you getting back into multifamily? Are you more
Oh,
focused
yes.
on alternatives, or what's happening in that space for you?
Yeah, so we have about 60 to 75%, it's always kind of rolling, of our offerings are in multifamily. And so it's
Yeah.
still a really strong core piece of our portfolio. And then we're adding other things to it to supplement. We're not finding very many cash flowing real estate properties. And so we're supplementing with other investments. Um, but we're definitely seeing it pick up a notch, not only in good deals that we're seeing, but our ability to pencil in a profit. So we just signed a PSA on something and we got 4.95 fixed rate agency debt. And it's like, okay, that's going to put a lot of investors' minds at ease. Like there's
Yeah.
now good debt to be had. It's fixed. It's at a decent rate. It's not like the rates back in the heyday, which would be great if we saw those again, but it's totally doable. And so I think getting to this point in time where it's like, oh, I can fix in sub 5. Like I know that I can make this profitable over the next 5 years. And so the more that we see things become more stable as far as the variables that we're underwriting with, the more that we can confidently take into our portfolio. So last year is more like we have to be really, 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 really sure and use like the most conservative underwriting in order to make an acquisition.
Yeah.
And now it's like, oh, okay, we don't have to assume what rates are going to do. We're locked in and it's great.
Yeah. Yeah.
So
Yeah.
I think it's going to pick up. Yeah.
So let me ask you a question, because we've wrestled with this too. Obviously flexible debt or bridge debt is, everybody's been afraid of that because of, obviously, rates have come up a lot.
Mhm.
We've had fixed rate debt on some of our deals, and of course, if you prepay or you need to sell or refinance early, we've paid millions of dollars as a penalty to be able to sell
Mhm.
that property. It still made sense to do it at times.
Yeah.
Have you had that situation come up at all in the past where you've had to do prepays or when you wanted to
Yes. So
refinance or sell?
in 2022, we sold some properties that had a prepayment penalty, but it was still worth it.
Yeah.
And especially because it was Q2 of 2022 and we knew what was going to happen with the rates. And so we were trying to get the sale before the rates changed. So we said, all right, if we hold it and we get into this period of interest rate, debacle that we all got into, we would have to hold the property for like another 5 years to get
Yeah.
back to the price we could sell it for today.
Yeah. So you
And so
sell it.
we
Yeah.
still were able to sell things at the annualized return investors received far exceeded the target annualized returns,
Yeah.
even with the prepayment penalties. So we said, it's worth it
It
just to
makes
make
sense.
sure that we exit healthy.
Yeah, we've wrestled with this too, because like we found a partner that's kind of, it's a little bit in between, where it's a large partner in, in-house, construction management, property management, over 3 billion in real estate, and they do it's technically bridge. They do a 3-year term, buy the rate down to 4.75, and then raise additional funds at closing so they can buy the fourth year cap, and then have an additional fifth year if they need it. But it's just they're well capitalized and they're putting less money down. So excuse me, more money down. So instead of 20% down, it's like 40% or 50. It's like a
Mm-hmm.
higher amount down. But what it
Mm-hmm.
does, it gives you the flexibility to be able to sell or refinance, which is great if rates,
Yeah.
stay the same or they come down. But
Yes.
again, it's great to have something locked in for 10 years, but then it's also like, it's hard to navigate that because no one has a crystal ball. If we knew exactly like, here's
Yes.
what's going to happen in 3 years, like, oh great, well, let's do that, but it
Right.
doesn't, like, we're looking at it on the front end. And so, and the safer way is I think the long-term fixed debt is probably safer, but there's also some limits to it as well. I don't know if you've looked at both
Yeah,
sides of that.
so we definitely tried to, so like for this one, it's a 7 year and you can negotiate in your terms prepayment penalty, no prepayment penalty after a certain date. So like no
Right.
prepayment penalty after 3 years, something
Right.
like that. So it's like, okay, sure, I can understand if we sell in 1 year, but after 3, come on, either let someone
Yeah.
assume it or let us exit it. Because like you said, it's hard to know after 3 years from now what's happening.
Yeah, yeah, that's good. That's
Mhm.
amazing. Well, what else? That's great. You're doing more stuff in multifamily. What are some other things? Well, let's talk before we get into other
Yeah.
things you're excited about. I know you're like me. You're always traveling. So I've traveled, I think, three or
Yes.
four times internationally this year, which is in Ireland. Went to base camp of Everest, and I know every time I
Awesome.
see you, you're always doing something.
Yes.
So where are you going, and what are some of the lifestyle things that you're enjoying lately?
Yeah, definitely. So this year, we did a ski trip in France, and then we did
Wow.
a summer trip in France. My husband's from France, so
Oh,
it's
okay.
not random that it's France. We go to see family. We went to Zurich to the mountains in Zurich, and our kids did all kinds of downhill mountain biking with family members, aunts and uncles and stuff. It was really fun. We went to England as well for a sea shanty festival. So my husband and I, before kids, we lived in Cambridge, England. And so the kids said they wanted to see where we used to live. And we're like,
Hmm.
okay, we went to the shopping center and there's this little tiny apartment above it. And we're like, you see that little tiny window? That
That's
was
where we
our, like, we
live.
used to live there. And they're like, that can't possibly be big enough. And we're like, yeah, that's where we lived
Yeah, yeah. They got
before
some
SuGo Capital.
small apartments there. Yeah, yeah. That's amazing.
Yeah. But
Wow.
yeah, we've really been able to say, hey kids, what do you want to do? And then we're able to go do it. We went to the Bahamas. We got a 35-foot sailboat and we just sailed around the Bahamas for a couple weeks in
Wow.
April for their
Amazing.
birthdays. So traveling is really, really important to us. And going back to your point about we all invest for different reasons. And so we all start companies for different reasons as well. And one of my reasons, which I kind of hinted to in the beginning, is time freedom and also location freedom. So you
Yeah.
can have time freedom, but have to, be somewhere all the time. Now my
Yeah.
husband has retired from Google, so we have ultimate time and location freedom. So I had
Yeah.
a lot of freedom, but he didn't. So he would always be working while we were traveling. And now that he doesn't work at Google anymore, it's like, okay, the family, we can go anywhere and we can do what we want to do when we want to do it. And we can all be
Great.
together and we can elect we're going to work on this trip or we're not going to work on this trip.
Yeah.
Is it vacation or is it travel?
Or both.
Yes, and it's just wonderful. It's really important
Yeah.
for us.
Well, I think it's interesting. I've had some conversations with people lately about it seems like it's more possible to do this now than it was 20, 30 years ago. Like what you
Oh,
and I do,
totally.
it used to be, especially when it comes to investing, people would like, locally would get together and there'd be a referral or there'd be a big dinner and you kind of do stuff. But now
Yeah.
we do stuff online and hundreds or thousands of people will watch, they'll get connected. So it's kind of cool that we're able
Yeah.
to do this, but also for investors, the idea of when you are able to scale up cash flow, a lot of people get started, and you've had many investor calls me as well. You get the doctor who's got a net worth of 5 million, who's only done stocks, and it's like, well, there's a way you actually can replace your working income or just your
Yes.
expenses, and then make work optional. What's some of the
Mhm.
things that you found for people to be helpful, kind of on that process where they're learning and maybe they've done one deal or they haven't really done a deal, and like the light goes on, like, oh my gosh, this stuff actually works.
Yeah. Well, hopefully don't be discouraged, first of all, if it doesn't work the first time.
Sure. Yeah.
We tried to buy so many multifamily before it worked. But I think being really, really clear about your goals. So you can do anything for 30 days, right? And so some people they want to take the easy street there. And a lot of people said, what was the turning point, Sarah? So for me, I kind of had a goal of I don't want to work anymore and I want to have some money. That's way too fuzzy of a goal. So I
Yeah.
had to sit down and I wrote down, okay, by this date, I want to replace my income. This is when I was starting SuGo Capital. So, okay,
Yeah.
I don't want to work in tech anymore. I don't want to go to an office and a job working for someone else. So I had a date and a number. I want to make this dollar amount from my investments by this date. I was like, oh, that seems impossible. I don't know how I'm going to do that. But I wrote it down and I sat down with my husband. So it can be whoever you make your financial decisions with. For me, it was my husband. And I said, this is our family goal. And he said, I don't know how we're going to do that. And I said, I don't either. It doesn't matter. And then I set incremental goals where for 30 days, I would do something completely new that would help us on our trajectory towards that goal. So I often would wake up early in the morning. I might buy a course and I would do 4:30 to 6:30 in the morning,
Wow.
5 days a week. I'm going to do that course. And at the end of it, maybe it changed my life, maybe it didn't, but either way, I got through it. You glean, okay, maybe that helped on the trajectory, maybe it didn't, but I continued to just try until we found the different things that when we put it together, it worked. But a lot of people don't want to put in the work.
Yeah. Yeah.
They want to just like get there. So I would
Yeah.
say set really, really specific goals. Time box the effort you're going to put towards your goals. So maybe, you're not quitting your job and starting a company. Maybe you're working for the next 10 years, but then after that, you want to be financially free. So what is your number? What is that income number you need every month? And by that 10-year date, and you write it down. And then, between now and then you're building your net worth until you reach a certain net worth number. And then you switch over to cash flow investments when you need the cash flow. Don't worry about it now because you're working for another 10 years. And getting really specific about a goal and a plan, and just try stuff that's going to work. Whatever you
Yeah.
like, learn as much as you can about it and get really, really good at due diligence and creating a really great ecosystem of, tax attorneys, tax planning, all that kind of stuff is so, so important. And people often don't pay enough attention to it. And that's going to create a hole. You're going to have a leaky bucket if you don't have a great
Yeah.
tax strategy.
No, it's really true. I think it can be overwhelming for people when they're first
Yeah.
starting out. And so I think it's something, when you hear all this, don't be discouraged. But I think that, it all does begin with a decision, right? Tony Robbins says it's in your moments
Yeah.
of your decision that your destiny is shaped. So I remember when I made a decision, I've said in 3 years, I'm going to quit my job. I don't know how I'm going to do it. I'm going to replace my income, my expenses. And it was really like what you said is that most people don't want to do the work. It's like everybody wants to, like, my new book, I'm writing another book called Rich Brain, How the Wealthy Change Their Brain to Change Their Bank Account. And most people's plan to get wealthy, honestly, is their rich uncle dies or they win the lottery. There's no plan. And then you look at lottery winners, most of them lose the money or they go bankrupt within a few years. And so, because they didn't really develop the character, they didn't really develop the work ethic, they didn't become the wealthy person. They just want to have the stuff, right? It's got to become the person first. And so, I think just that work ethic is really important. And so, I love passive income, but there's a lot of work to be able to get to passive income. It's not just like you flip a switch. Oh, I learned about passive income. Now all this money's just raining down from heaven.
Right.
It's like,
Yeah.
it's a lot of work and it's time and it's effort. And the investment is we really make the investment ourselves. And like you said, and thank you for sharing that, it may not go well the first time. I remember one of my first investments didn't go well. And I've had, my book, I talk about how I tried trading options and I've made 20 grand and then I lost 70 grand. So it was like I ended up, these things are all learning. And so
Yes.
the investment we really make is in ourselves. And then over time, all you need is to learn the skill and then maybe have a few really good deals that perform really well. And that can really take you to the next level. It depends on what types of deals, obviously, we're doing. We want to minimize losses. But what other tips do you have? I know we're kind of getting to the end of our time, but what other tips do you have for people that are getting started or are maybe like, oh, this looks interesting, but I don't quite know how to, like, what are some steps I should do to get started?
Yeah, you mean in investing in general or specifically in real
Yeah, I
estate?
mean, you kind of gave some earlier, just, really making the decision and working hard, but just, I mean,
Yeah.
or maybe some pitfalls to watch out for when people are starting to do alternative assets outside of Wall Street.
Yes, I think the most common pitfall I see is that people believe the negative and don't believe the positive, which is really funny to me because I always believe the positive and then the negative, I'm like,
You're an
I'll take that
optimist,
with a
yeah.
grain of salt.
Which that can also be harmful in investing too, if we're, I
Yeah.
learned that about myself too. So,
But, when I was going to buy my first duplex and, a family member said to me, "Ooh, yes, but, my friend bought a duplex and she lived on one side. It was an awful person on the other. She lost money, da, da, da. You should stay away from real estate." Like, okay, well, that one person you knew made a bad choice. But look at these millions of people in the US who've made billions of dollars in real estate. I choose to look at those people. And the same is true with buying a business. They have all those stats around 90% of small businesses fail. Yes, but then there's a lot of business owners who are extremely wealthy. So
yeah.
make sure you pay attention to who you're looking at and who you're listening to, because it is all possible. And you just have to make sure you're listening to the right person and don't listen to the person who couldn't make it work. Listen to the person who has made it work. And there's a lot of people out there who say they made it work and they didn't really make it work. So make sure it's the real deal.
Yeah, and that's where the vetting and the
Yeah.
referrals and all that stuff takes place, and the education for
Yes.
yourself. Well, Sarah, I really appreciate you. It's been great being friends and knowing you and all that value that you're adding to so many people. I know we have a lot of people that have worked with both of our groups, so really grateful for you.
Yeah.
How can people follow you, hear about your deals, get in touch with you, and hear about what you're doing?
Yeah, so there's always my website, sugocapital.com /open. That's our open investment opportunities. But what I think is, something that would be a big give to people who are listening, if you are just getting started or you're pivoting or something like that, I have something, and it's a 3-day mini series, and it's about exactly what we talked about here today. So it's freedomin3.com, freedom in the number 3.com, and it's a 3-day mini series. And so I really go into building your, like, writing down what are your values, what are your goals, how are you going to get there, how to do a 30, 60, 90-day plan for your investment strategy, and how to move forward from that. And we do it in 3 days. It's just an hour a day. And our investor community, almost everyone has gone through that and said that it was so powerful because it's really simple and really actionable. There's homework. It's just like boom, 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 get it done. And it's so easy to take action off of it. So that would be my gift to the community. If you are looking to make a plan on how to reach financial freedom or your investment goals, and it's just freedomin3.com, the number 3.
Freedom in 3. Awesome. Well, great, Sarah. Appreciate you. Thank you so
Yeah.
much for being here. Look forward to connecting with you again soon.
Sounds good. Thanks so much, Bronson. Thanks for having me, and thanks to everyone who's listening.
All right. Well, that was a great interview with Sarah. Again, I really loved some of the diligence stuff that she shared. She talked through kind of her own process and the ways that she has grown, adapted, and changed. And I think as an investor, it's just so important that you're continually learning, you're continually growing, you're adding into what you used to do. And the idea of hiring this group that does private investigator work, I mean, you're going to get a lot more information than just putting something into an online database for background checks. And so I think it's a really, really great strategy. So anyway, if you haven't heard or have not joined our investment club, we have some unique deals, particularly that are cash flowing business deals that are coming out. And we found that, cap rates typically for multifamily in a lot of markets now, great markets, are about 6. So basically that means if you paid cash for something, a 6% cap rate is reasonable. So it's about 6% return if you paid cash for the whole thing. Well, there's businesses, if you buy the business, you're basically getting, with your cash flow and it's unbelievable. Some of these are 3 or 4 times earnings, which can be sometimes a 20 to 35 cap rate, right? So it's just very, very high returns from a cash flow perspective. Obviously, there's diligence there and there's all those things. But so anyway, if you haven't joined our investment club, you're not going to hear about these amazing deals we're doing. So to check them out, you got to go to bronsonequity.com and click the join button, or you can click the link below. We'll start a relationship with you and we can let you know about our deal flow. So thanks for taking the time to educate yourself. We'll see you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.